Hi, this is Randy Finney with the Right Side of the Chart, and this is a late morning session update, I should say, for Tuesday, August 13th, 2019. I wanted to get this video out quick. I just got back. I was working at my desk this morning, looking at all the charts I'm watching, and I had a pop-up on my phone to remind me that I had a dentist appointment today. Working out of the house, you don't always check your schedule where you need to be, and so I had to scramble. That was a 9:30 appointment, and when I left, futures indicating about a flat open, but we got, as I said, I fired off an update today right when I got back. Not by any surprise. It's almost like clockwork when the market is selling off or in a very, very precarious technical spot. As I said yesterday, would have, if we went much below those gaps, that would have triggered most likely set off a lot of stop loss orders. So, I'm not a big conspiracy theorist guy, but I have absolutely no doubt, because I've just seen it over and over, that Washington will come in, especially this administration, at strategic points and flip from being, Trump being very taking a tough stand on trade wars to backpedaling, and that's exactly what happened today. And again, I've said it in recent videos, it's not the first time this has happened. It's almost, you can almost set your watch to it, that you'll have a tweet come out or some news. So that was it today. They're backing off the latest tariff threats, at least for a time being. And so here's my view. Now, I also want to say this, as I'm doing this video, as I sat down to do the charts, I looked at yesterday's candle. I was clicking here, and I'm showing a low of 183.50. Now, on that post for the trade setup yesterday, I said the entry would trigger on a break of 183.52. I'm sorry, below 183.52. So that would say any print of 183.51 or less. And at 3:04 p.m. I posted, I had just checked, it took a minute for that post to hit, on the comments section. At exactly 3:02 p.m. Eastern, I waited till that candle was closed. The low at that point in time I was showing was 183.52. So I'm just catching up now. I'll have to check other charting platforms. It is quite common that one charting platform will have a different, different high or low, or sometimes even a different closing value based on whatever data feed they're using. They should all be the same. And now I'm showing that, although that wasn't there yesterday as of 1:53, I'm showing at 3 o'clock on the intraday charts. That's when they must have revised that candle to show a low of 183.50. Either way, I'll clear that up. I'll check with a couple. I have to verify with a couple other charting services to see what the actual low was. But when I got home and I saw that we're up, I revised that entry to current levels. So whether you took it yesterday, whether you took it today, I think we're going to the same spot. And the way I look at it is, there's about, I revised the stop, of course, based on this entry here, and that would be about a 3% stop. And the downside to that first target, which would be the same as over 10, about 10.25%. So better than a 3-to-1 RR. Again, we'll have to see where that yesterday's low was. Now I want to go over the charts and my thoughts. My thoughts are, first and foremost, because I kept tried to get that post out as quick as possible, that everything, I'm a very firm believer in the charts. Technical analysis, at least in the near term, can be foiled. You can use, news events come in strategically. The Fed can come out and do something, and that causes an initial knee-jerk reaction. But the charts are really a story of buyers and sellers, where they've met in the past, volume, things like that tell you, indicate with in some instances, not always, but in some instances, with a pretty high degree of certainty where things will be headed. And so I'm just jumping back here to this weekly chart. I want to show you that, again, we had back in last fall, we had an almost identical setup. We had the negative divergence, everything that was highlighted back then coming into there. We had bearish golfing candle here on this weekly time frame. That's when it comes at the end of an extended uptrend, and most importantly, not just randomly, but when there's already a clearly bearish technical setup, technical posture, as there was back then. I was highlighting, you don't see it here on this chart because I had on the daily, I had uptrend lines on QQQ, XLK, and everything almost identical to what just happened. And I said, when tech breaks, the market will break. And there we went. So that was the biggest correction in the entire 10 plus year bull market, and it was clearly telegraphed by the technicals, not just a bearish engulfing candle, but that certainly helped. And then again, we came full circle. We simply extended the divergence, and then we put in a week before last, we put in another bearish engulfing candle there, and we had follow through with the red candle. Now there is, like I said, there's some support that was hit recently. Little work to be done to really firm up the longer term bearish case. But again, this is the early signs, and so whether or not it works out, like I said, I look at 3% upside. If you want to look at where it went in yesterday, I'll have to see where that is. 5% upside for a stop. To me, that's still very reasonable stop allowance, if you will, for my longer term swing target. This is not an official target yet, just the potential to come down here, which is now about roughly almost 40% lower. But even a correction down, going back to the daily charts, because that's just have to see how this all works out. That target now is over 10% down below. So I view everything like I said, odds, probability, statistics, and risk reward. Don't risk a dollar to make a dollar. If you do that, you have to be well over a 50% win ratio, and that sometimes you can do that. Depends what securities you're trading, but they're usually the risk rewards change there. So let's just talk about the technicals and where this rally ideally needs to stop. Again, we're really at this point in time, you can see, remember I have my uppermost bounce target zones. This is, by definition, unless you're new to the site, you've heard me say many times what I refer to as a momentum fueled overshoot. So as of now, and this could all change, I'm going to give you both sides of it. I'm going to try to do this with an unbiased, objective lens here. So you can look at it this way and say that is a bull flag, because you have a very powerful move, which would be your flagpole, a single 60-minute candle so far, flagging action, and that would project to something like this. And if that's the case, and you're bullish and long, you go long. So a couple things have happened today. That's set up. It's not my preferred scenario. I think this is a knee-jerk reaction. It caught a lot of traders off guard that were positioned because the charts, the trend was bearish, the near-term trend off the highs, and the technicals, everything was bearish. It wasn't pricing in a bounce at this point. So when Washington comes out and all of a sudden out of the blue says, oh yeah, no, we're gonna hold off, we're gonna make peace right now with China, that's gonna catch the market participants off guard, and that's where you get the big move. And remember, big moves like this, and I've said this in recent videos, and it was also confirmed in an article in Wall Street Journal, but I know this to be true over the years. The biggest gains in the stock market come during corrections and bear markets, not during rallies. And so what you have is a lot of short covering and this and that and the other. So there's the what I call a momentum fueled overshoot because of the news catching traders off guard. We popped my max bounce target there of 188.37, but not in a natural walk up progression way. So as of now, and again guys, this could all change and then I'm wrong. If this breaks out and this bull flag plays out, if it breaks out anything more than just a false breakout, then I'm wrong. We're going up here, and then that could open the door to new highs, and that's why I have a stop somewhere, not just set a little bit below the new highs or the all-time highs, the previous highs. So as of now, I'm viewing this as a news-induced, call it a market manipulation, whatever you want, and a retest of that max bounce target, because again, this was simply a momentum fueled overshoot. When did I get back to my desk? I got back less than half an hour ago. This has only been a couple hours of trading, and we snapped right back down there. Look what we're trading now, 188.40. So essentially this is just a second test of my max bounce target on QQQ. SPY, I had a max bounce target of 293.99, call it 294. Look where we hit a high today, a momentum fueled overshoot of 294.15. 15 cents on a 300-point security too is statistically insignificant. And again, you can look at this glass half full or glass half empty. I'm looking at it glass half empty, meaning the bearish case, because of what I just started with on the weekly charts, because of the trend, because of the price action I've seen recently. So lots of ways to play it. If you're bullish, watch for a breakout of the bull flag. If it breaks out, set your stop, somewhere below and ride it on up. If you're bearish, look for either failure for that bull flag to materialize, because even the only thing worse than it just going down would be a false breakout. We pop, all the more shorts cover, more longs jump in, and then it reverses. So shorts could do that. Look for a failure on the flag, or look for the flag to just not simply materialize, because that's also quite bearish when you see what appears to be a pretty clearly bullish pattern and it fails to materialize. And then at the end of the day, that's all things that may or may not happen. Let's keep it very simple. There's resistance right there. We tried to pop it briefly on a momentum fueled overshoot 294, and again, going back to SPY, same levels I was talking about week before last, 188.37. We're dancing around it now, but I look at both large cap indexes together. QQQ is essentially on it again. $100 to $200 security. It takes 10, 15 cents in either direction, really isn't moving the needle. You got to give it a little bit of slack, if you will, there on those levels, especially when you have high volatility like this. Okay, so before I get off these 60-minute charts, I shared my view that I think this is a pop that's going to be faded. And again, I use that opportunity to, me personally, came back. I had shorts, even though I didn't see that short trigger yesterday. I trade NQ anyways. I had a core short position there, and I've added to that. I've actually doubled up right when I put out that post today. And I'm gonna, because I doubled up and I had a lower cost basis, I'll set a stop on today's lot relatively tight, and I'm gonna leave that other core position, give that a little room. Negative divergence right here, 60-minute chart. So that's one thing to note. Right there, you can see the PPO right here. It's only potential divergence. If this pop continues to go, if that bull flag breaks out and we run, this divergence will be burned through. Again, not my primary scenario, not what I think is going to happen, but I'll have to respect it if it does, because we'll no longer have divergence. If the bull flag breaks out, it could keep going. So I want to throw that out there to you guys. It's certainly worth noting that that's in the in the charts. And then SPY 60-minute chart, same thing, negative divergence there as well. Here's the SPY daily. I wanted to show you this as well. Okay, if you recall, we had an uptrend line off the lows, off the December 24th lows on both SPY and QQQ. SPY broke down recently. It made a back test, rejected, and it's back testing again. So we're still below the trend line, and we're still right around those max bounce targets as well. So there's resistance there on SPY. QQQ had it drawn a little different. I had this trend line here. QQQ hit the trend line along with the 200-day, but it's also again at price resistance, my max bounce target. And remember, QQQ had, and please understand, this is what goes into my bias. Why am I a non-believer in this move today versus a buyer? Because now look, good, China and the U.S. are making peace again on the trade wars. Why do I not buy into it? Because of this. This was a powerful failed breakout. This was a breakout to new all-time highs. The SPY also broke out to an even more significant level. QQQ just took out the previous reaction high, where SPY had two previous highs, and it failed. And it didn't just fail by a little bit. It failed very impulsively. To me, this is a powerful sell signal that has longer term bearish implications. So therefore, I'm viewing today's pop as a gift. Maybe I'm wrong. Maybe it's a gift to the longs, but I view it as a gift to the shorts, add to shorts, at a better level. And again, I've got compartmentalized. I have swing short positions. Those I'm holding on to. My active trading account today, I had some, went into the day with buying power, dry capital, I should say, dry powder, because we closed right at support yesterday, and even the futures overnight didn't really, determine much. Like I said, when I left, we were looking to open about flat. So that's it. There's my thoughts. And as I said in the update that I posted out there, do what you're comfortable with. If you don't, if you don't like shorting when the market's up 2%, then you don't need to do that. Don't ever do anything that doesn't agree with your views on the market, your comfort level, your risk tolerance. Let me wrap this up by looking at the futures. Like I said, I really haven't even had time to mark these charts up, but I did glance them. I wouldn't have put that trade out there if I didn't glance everything first. I just moved a line I didn't mean to move. There's a resistance level just overhead on NQ. What I'm trying to do here, and I'll draw it with this line, here's that negative divergence. Look at that. And it's pretty strong if it's confirmed. If we turn down from here, which I suspect, and already we're starting to, as now as I'm doing the video, we're starting to get a reversal here in the futures and QQQ as well. There it is, you can see it there. Now it's starting to foil the potential flags. This move down is pretty impulsive. If a flag ideally symmetrically or for the pattern should look something like this, not so steep like that. To me, this was just like I said, a fade that caught a lot of market participants off guard. Those that are bullish and wanting to think the market's going up to new highs anyways, it gave them an additional reason to buy. It certainly kind of muddled the short-term technicals, and I have no doubt that it squeezed out a lot of shorts that weren't expecting that, might have been too heavily positioned or just had stop loss orders above. And again, it's like I said, I strongly believe it to be a strategic, the timing of that, to release that right before, right around, I guess it happened right either before or after the market opened, when all the institutional players on the field and all the stops can be hit. Remember, stops on the futures can be hit around the clock, but futures make up a very, very small percentage of the trading volume. It's at 9:30 a.m. Eastern time when the market opens. That's when the starters, the big boys, they all step onto the field. Those are institutional traders that cannot maneuver. If you're running billions of dollars in capital, you can't maneuver in the after-hour session. There's not enough liquidity to effectively trade. So the big institutions, the algos and all that, they run primarily in the regular session. And so again, the timing of that was, to me, pretty obvious. So there's that. That's NQ, ES. Right there. I already marked this one up. There's your negative divergence right there. We're going to have to go down quite a bit more to confirm it, but the more we go down, the more it helps to foil what could be those flags I started talking about as I do the video. And this move down again it's not indicative of a bull flag pattern. It's a little too steep. In fact, what we can do, and then I'll wrap it up, is look at it on the indexes here. So yeah, there it is on the 60-minute chart. Take it down to a 15-minute chart. Still, yeah, that's not, they pretty much foiled what could have been some flags. And as you can see as I'm doing the video, and that's again why I wanted to get this out to you guys, this is where I got that post out somewhere up here, and they're fading it pretty far. Now look, we're still up 1.76. Can't get excited yet. So but the more we go down, and let me say this, and I'll leave it here, if, as I suspect they will, but it hasn't happened, it's a big if they wipe out this candle, it's a get out of Dodge moment. Yeah, the other day I said, on the daily chart, if they wiped out this candle, which they did, it would be quite bearish, but again, you had big gap support right there, which QQQ made an almost perfect back test of. So as I said the other day, when this happened, 3 check marks. Number 1, wipe out the candle. That's check mark for the bearish case, number 1. Number 2, take out the bottom of last Monday's gaps. That didn't happen yet. That's still pending. So I'm going to put an X there, and then finally nail in the coffin, take out those lows. So right now we had 1 check mark, and the next check mark will occur if we take out the bottom of Monday's gaps. We're also going to take out this candle. So that'll give us that check mark, and it'll be a little bit more powerful. So I'm looking at several things that haven't happened yet. So keep that in mind with 2 things. Number 1, your overall position size, how much you want to put in. Everybody's different, but you don't, if the sell signals, there's still, like I said, several check marks that have to happen for a sell signal for a swing trade of at least that 10% drop that I showed you to the first target on QQQ. So you can always add if and when this, you get this check mark and this check mark. At that point, you would be to a full position. And a full position, please, once again, is not 100% of your portfolio. It is a full position. To me, says, here's my portfolio. It's a pie, and in that pie I have pieces of the pie. That piece might be how much, if I'm bearish on the stock market and I want to short the markets, whether it's SPY, QQQ, individual stocks, a combination of, that's that piece of the pie. And that pie can be different. Treasury bonds, long or short, corporate bonds, gold, commodities, natural gas, or cash. In most trading accounts, a lot of times, unless the market is you have a lot of sell signals, there's a lot of things popping, there's always going to be, or should be, a portion of this that's in cash in a trading account, because you need that cash to jump on sudden opportunities to present themselves. It's not like an investment portfolio where you may be, if you're young, long-term time horizon, you may be fully invested. But even in that investment portfolio, it will look like this. Let's say you're 30 years old. You might have normally 70+% of your money in stocks. International, U.S., everything else. You might have 20-30%, whatever, the rest into gold, commodities, precious metal, maybe a little bit of bonds for diversification. Good idea always. That's an investment portfolio, but a trading account's different. So everybody's different, but again, when I say a full position, that doesn't mean 100% of your portfolio. It doesn't even mean half of your portfolio. It shouldn't be in one single trade. Depends, but a trading account, I like to say at least 10 positions, so ideally then you don't want to have much more than 10%. But if you're trading the markets long or short, you can go up 20, maybe even 30%. Because why? Because QQQ is 100 different stocks in different sectors. SPY is 500 different companies in even more sectors, among 11 different sectors in the economy. So you have diversification. You don't have the risk of an overnight gap from earnings miss or beat, because the index, if one stock out of 500 has a big gap up or down, it's not going to move the needle too much on SPY. So that's a little bit on that. All right, let's wrap it up here so I can get the video out to you guys. And look, by the time I get it out to you, it's possible I'm wrong and this thing takes up, but I highly doubt it. Again, a 2% up plus move in QQQ is close to pushing the limit of what it's going to do, and the fact we're in a downtrend makes me say fade it. Your odds are good at fading that. If I had let's say, come back here, I told you I'd stop, but I just want to keep talking because there's so much going on today. Here's SPY. If I had, let's just say, for example, well, we already had a breakout in SPY, but this was it. This is the level I was talking about when SPY broke out. We had a failed attempt there. That was all-time highs. Tried again at it, failed. Tried again here, failed. If I saw that big green candle on high volume and I didn't have negative divergences, as we did then, and other things, that would be a breakout that I would chase, and I would not try to fade. So please understand that I wouldn't normally just jump in and try to fade a 2.5 plus pop in the QQQ. And I may be wrong on this one, but to me, this is the type of 2+% pop I want to fade. It comes in the right market conditions. It's not a breakout, far from being a breakout. It's in the middle of a downtrend. So there, that puts the odds, against it playing out for more upside. Doesn't eliminate it, but puts the odds against it. So, all right, I'll get this out to you guys, and I'm going to dive back into the charts, see what else might be moving today. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.